Hello everyone, this is Hardik from Team Mastercamp, and today we're going to take a look at pricing models across industries. Let's get started. Pricing is a fundamental aspect of any business, regardless of the industry it operates in. It's a delicate balancing act requiring businesses to consider various factors from the cost of production to the perceived value of their offerings, competitive landscapes, and evolving customer behaviors. Effectively navigating this complex terrain can be the key differentiator between success and failure. Understanding the nuances of pricing strategies empowers businesses to optimize revenue, capture market share, and build sustainable profitability. Here are all the modules which will be covered. By the end of the course, you will be able to identify and analyze the various pricing models used across different industries, understand the key factors influencing pricing decisions, including cost, competition, customer behavior, and market dynamics, evaluate the strengths and weaknesses of different pricing strategies in specific contexts, apply pricing principles to develop effective pricing strategies for various products and services, recognize emerging trends in pricing, such as the use of AI and personalized pricing, make informed pricing decisions that contribute to businesses' profitability and success. The first pricing model we're going to take a look at is of pricing in the retail industry. The prices we see in the stores, both physical and online, are the result of careful consideration and strategic planning. Retailers constantly grasp with questions of how to price the goods to attract customers, compete effectively, and ultimately make a profit. From everyday groceries to high-end fashion, the pricing strategies employed are diverse and reflect the unique characteristics of the retail landscape. Understanding these strategies is crucial for anyone involved in buying, selling, and analyzing the world of commerce. Different pricing strategies across retail industries are cost plus pricing and markup strategies. This is a foundational pricing method where a retailer calculates the total cost of producing or acquiring a product and then adds a fixed percentage to determine the selling price. This fixed percentage, also known as the markup. For example, if a shirt costs a retailer $10 to acquire, then they apply a 50% markup. The selling price would be $15. While simple, this method doesn't always consider market demand or competitor pricing. It's often used as a starting point and adjusted based on other factors. Next is price scheming and penetration pricing for new products. These are two contrasting strategies used when introducing new products. Price scheming involves setting a high initial price to capture early adopters willing to pay a premium. As demand stabilizes, the pricing is gradually lowered to attract more price-sensitive customers. This strategy is effectively for innovative products with limited competition. Penetration pricing, on the other hand, involves setting a low initial price to quickly gain market share and discourage competitors. This is often used for products with high potential demand where economics of scale are important. Psychological pricing tactics. Retailers often use psychological tricks to influence purchasing decisions. Odd-even pricing creates a perception of a lower price. Prestige pricing uses high prices to signal quality and exclusivity. Charm pricing is also a common tactic. These strategies exploit cognitive bias to make price appear more attractive. Promotional pricing and discounts. These tactics are used to stimulate sales and clear out inventory. Discounts can be percentage based or fixed amount. Sales events create a sense of urgency. Coupons and rebates offer price reductions to specific customers segment. Retailers carefully plan promotional pricing to maximize their impact. Finally, pricing in e-commerce and online marketplaces. Online retailers adds another layer of complexity to pricing. Dynamic pricing adjusts prices in real time based on demand, competition, and other factors. A/B testing allows retailers to experiment with different pricings to optimize conversion rates. Online marketplaces like Amazon often have intense price competition requiring retailers to be agile and responsive. Transparency is also a factor, as online shoppers can easily compare prices across different sellers. Now let's see pricing in the service industry. The price tag on a product tells a simple story: the cost of materials, manufacturing, and a bit of profit. But what about the services? How do you price something intangible, something that relies on skill, time, and the specific needs of a customer? The world of service, from a quick haircut to complex legal advices, presents a unique challenge when it comes to pricing. It's a delicate balance between value expertise, covering costs, and ensuring the customer feels they're getting a fair deal. Different pricing strategies in service industries include time-based pricing and project-based pricing. Time-based pricing is common for services where the time spent is a primary factor like consulting or legal service. Professionals charge an hourly or daily rate. Project-based pricing is used when the scope of work is defined upfront and a fixed price is quoted for the entire project. This approach is common for website design or construction projects. Both methods require careful estimation of time and resources. Value-based pricing for professional services. This strategy focuses on the perceived value that the service provides to the client rather than just the cost of providing it. For example, a consultant might charge a premium if they have a proven track record of delivering significant results for their clients. Value-based pricing requires a deep understanding of the client's needs and the benefits they will receive. Pricing for subscription and membership. This model involves charging customers a recurring fees for access to a service or product. It's common for software as service or SaaS, gyms, and streaming platforms. Subscription pricing provides predictable revenue streams and fosters customer loyalty. Different tiers of subscriptions can offer varying levels of access and features. Dynamic pricing in the hospitality and travel industry. Hotels and airlines often use dynamic pricing where prices fluctuate based on demand, time of the year, and other factors. Prices tend to be higher during peak seasons and lower during off-peak seasons. This strategy allows businesses to maximize revenue by capturing different price points in the market. Finally, pricing in the sharing economy. Platforms like Uber and Airbnb operate in the sharing economy, where individuals can offer their services or assets to others. Pricing in this context can be complex, involving factors like supply and demand, location, and user ratings. These platforms often use algorithms to dynamically adjust pricings. They also have to consider the balance between attracting service providers and keeping prices competitive for customers. Next, we're going to take a look at pricing in the manufacturing industry. From the raw materials to the finished product, every item we used goes through a journey of manufacturing, and each step of that journey, someone somewhere is making a crucial decision how much to charge. Pricing is in the manufacturing world isn't as simple as just adding up the costs. It's a complex interplay of production expenses, market dynamics, and strategic goals. Different pricing strategies used in manufacturing industries include cost plus pricing and break-even analysis. Cost plus pricing in manufacturing is similar to retail but with a focus on production costs. Manufacturers calculate the total cost of producing a unit, including raw materials, labor, overhead, and add a markup to determine the selling price. Break-even analysis is crucial for manufacturers. It determines the minimum numbers of units that needs to be sold at a given price to cover all costs and still start making a profit. This analysis helps manufacturers set realistic price targets. Volume discounts and tier pricing. Manufacturers often offer volume discounts to incentivize large orders for distributors or retailers. This can help them achieve economics of sales and increase sales volume. Tiered pricing involves setting different prices for different qualities of products. For example, a manufacturer might offer a lower price per unit for bulk orders. Competitive pricing and market share strategies. Manufacturers operate in competitive markets and must consider pricing strategies of their rivals. Competitive pricing involves setting prices based on what competitors are charging. Manufacturers may choose to price their products slightly below, at, or above the competition depending on the market positioning and desired market share. A market share strategy might involve lowering prices to gain a large portion of the market, even if it means lower profit margins per unit. Pricing for customized products or services. Many manufacturers offer customized products tailored to specific customer needs. Pricing customized product can be challenging as it requires estimating the additional costs associated with customization. Manufacturers may use cost-plus pricing with a higher markup for customized items or develop more sophisticated pricing model that accounts for the complexities of the customizations. Finally, pricing in supply chain and distribution channels. Manufacturers need to consider pricing throughout their supply chain. They set prices for distributions, wholesalers, and retailers, and these prices ultimately affect the final price paid by the consumer. Manufacturers must also manage pricing across different distribution channels, for example online, brick and mortar stores, etc., to avoid conflicts and maintain constant brand image. They sometimes use strategies like price cleaning, offering products at a specific price points to simplify pricing decisions across the supply chain. Next, we're gonna take a look at pricing in technology industry. In today's world, technology touches nearly every aspect of our lives, and behind every app, software, and digital service is a price tag. But how do you put a value on something that can be infinitely replicated, where the cost of producing one more unit is practically zero? Pricing in tech industry is a unique challenge, a complex equation balancing development cost, perceived value, and the ever-evolving expectations of users. Pricing strategies in technology industries include value-based pricing for software and digital products. Tech companies often use value-based pricing, focusing on the benefits and value their software or digital product delivers to customers. This requires understanding the customer needs and how the product solves their problem. The price is then set based on the perceived value rather than just the cost of development. Freemium and subscription pricing models. Freemium involves offering a basic version of a product for free to attract a large user base, then charging for premium features or functionalities. This model relies on converting free users into paying customers. Subscription pricing is very common in the tech industry, where customers pay a recurring fees monthly or annually for access to softwares or service. This provides predictable revenue streams and encourages customer loyalty. Usage-based pricing and pay-as-you-go model. Usage-based pricing charges customers based on their actual use of the product or service. This is common for cloud computing service where customers pay for the storage, processing power, or bandwidth they consume. Pay-as-you-go models are similar, where customers are charged for each unit or service they used. Dynamic pricing and search pricing in technology platforms. Tech platforms like ride-sharing or e-commerce often use dynamic pricing to adjust prices in real time based on demand, supply, and other factors. Surge pricing in a surge pricing is a specific type of dynamic pricing used during periods of high demand where prices are increased to balance supply and demand. Finally, pricing in the app economy. The app economy presents a unique pricing landscape. Many apps are offered for free, relying on in-app purchases or advertising revenue. Others use a freemium model, while some charge a one-time fee for the app. Pricing in the app economy is highly competitive, and developers need to carefully consider their pricing strategies to attract users and generate revenue. Factors like user reviews, competitor pricing, and app store visibility plays a significant role. Now let's take a look at pricing in the healthcare industry. Healthcare. It's a fundamental human need, yet the cost of receiving care can be a significant burden. Pricing in the healthcare industry is unlike any other, a complex web of costs, reimbursements, and ethical considerations. How do we balance the needs to fund research and innovation with the imperative to make healthcare accessible and affordable? Pricing strategies in healthcare industries include cost-based pricing and reimbursement models. Cost-based pricing in healthcare involves calculating the cost of providing a service or treatment and adding a markup. However, this is often complicated by complex reimbursement models from insurance companies and government programs like Medicare and Medicaid. These reimbursements often don't directly reflect the actual cost of providing care. Value-based pricing and outcome-based pricing. Value-based pricing in healthcare focuses on the value that a treatment or intervention provides to the patient, such as improved health outcomes or quality of life. Outcome-based pricing takes this a step further where payment is tied to achieving specific health outcomes. These approaches aim to shift the focus from volume to value in healthcare. Negotiated pricing and bundled payments. Negotiated pricing is common between healthcare providers and insurance companies, where they negotiate payment rates for various services. Bundled pricing involves a single payment for a complete episode of care covering all the services provided. This encourages providers to coordinate care and reduce costs. Pricing for pharmaceuticals and medical devices. Pricing for pharmaceuticals and medical devices is particularly complex and controversial. Factors like research and development costs, patent protection, and market competition plays a significant role. There are ongoing debates about the high pricing of some drugs and devices and the need of greater transparency. Ethical considerations in healthcare pricing is a complex topic. Healthcare pricing raises several ethical considerations. Should life-saving treatment be priced based on market forces, or should access to healthcare be considered a fundamental right? How do we balance the need to incentivize innovation with the need to ensure affordability? These are complex questions with no easy answers. Transparency, fairness, and equity are crucial considerations in healthcare pricing. Finally, let's take a look at pricing in the financial services industry. The world of finance is built on numbers, but those numbers aren't just about profits and losses. They're also about prices, the cost of borrowing money, the fees for managing investments, the premium for protecting against risks. Pricing in the financial services is a unique landscape shaped by intangible products, complex regulations, and the ever present element of risk. Pricing strategies in financial service industries include fee-based pricing and commission-based pricing. Fee-based pricing is common for services like financial planning or investment management, where clients pay a fee for the advice or services provided. Commission-based pricing is used by brokers or sales agents, who earns a commission based on the transactions they execute or the products they sell. Both models have their own advantages and potential conflicts of interests. Interest rate, price, and yield management. Banks and other financial institutions generate revenue through interest rates pricing, charging interest on loan and other credit products. Yield management involves adjusting interest rates and fees to maximize revenue based on factors like market conditions, risks, and competition. Risk-based pricing and credit scoring. Risk-based pricing is fundamental to lending and insurance. Lenders assess the creditworthiness of borrowers using credit score models and charge higher interest rates to those deemed riskier. Insurers use similar techniques to assess the risk of insuring individuals or assets and charge premium accordingly. Pricing for insurance products and financial institutions. Insurance pricing is based on actuarial science, which involves calculating the profit probability of certain events occurring, example, accidents, illness, etc., and setting premium to cover potential payouts. Pricing for financial instruments like stocks, bonds, and derivatives is complex and depends on factors like market supply and demand, risk, and expected returns. Finally, regulatory considerations in financial services pricing. The financial services industry is heavily regulated and pricing practices are subjected to scrutiny. Regulations aims to protect consumers from unfair or deceptive pricing practices and ensure market stability. Transparency and disclosure of fees and charges are crucial in this sector. For example, regulations might limit certain types of fees or require clear disclosure of interest rates and terms. Now let's see emerging trends in pricing. The world of pricing isn't static. It's a dynamic landscape constantly reshaped by new technologies, evolving consumer behavior, and the ever-growing flood of data. What worked yesterday might not be obsolete tomorrow. The rise of e-commerce, the proliferation of data analysis, and a deeper understanding of customer psychology are all converging to create a new era of pricing. Businesses are no longer limited to traditional cost-plus models or simple markups. They now have access to sophisticated tools and vast amounts of information, enabling them to personalize offers, predict demand fluctuations, and optimize pricing strategies in real time. This constant evolution demands that businesses stay ahead of the curve, embrace new approaches, and adapt to the ever-changing dynamics of the marketplace. Few key emerging trends in pricing includes artificial intelligence and machine learning in pricing. AI and machine learning are revolutionizing pricing. These technologies can analyze vast amounts of data to identify optimal pricing strategies, predict demand fluctuations, and personalize pricing offers. AI-powered pricing tools can dynamically adjust pricing in real time, taking into account multitude of factors that would be impossible for humans to process manually. Personalized pricing and customer segmentation. Personalized pricing involves tailoring prices to individual customers based on their past purchase history, demographics, browsing behavior, and other data. This can be highly effective in maximizing revenue but also raises ethical concerns about fairness and discrimination. Customer segmentation involves dividing customers into groups based on shared characteristics and offering different prices to each segment. Behavioral economics and pricing psychology. Behavioral economics studies how psychological factors influence purchasing decisions. Understanding these biases can help businesses design more effective pricing strategies. For example, framing prices in certain ways or using decoys can influence how customers perceive value. Pricing psychology explores how customers perceive and respond to different pricing tactics. And finally, the impact of big data on pricing decisions. Big data provides businesses with unprecedented insights into customer behavior, market trends, and competitive dynamics. This data can be used to make more informed pricing decisions, optimize pricing strategies, and personalize pricing offers. Data analytics tools can help businesses identify patterns and trends that would be difficult to spot otherwise. We have journeyed through the diverse world of pricing, exploring the strategies and challenges faced by businesses across a spectrum of industries. From the tangible costs of manufacturing to the intangible value of services, we have seen how pricing is far more than just a number on a price tag. It's a strategic lever, a reflection of market dynamics, and a key driver to profitability. In the ever evolving marketplace, staying informed about emerging trends and adapting pricing strategies will be crucial for success. Whether you are setting prices, analyzing markets, or simply making purchasing decisions, a deep understanding of pricing principles empowers you to navigate the complexities of value exchange in the modern economy. With this, we have now come to an end. I hope you understand pricing models across different industries in a better way. This is Hardik from Team Mastering Up, and thank you for watching.